what do you make of the diversification benefits, George? I know that's another potential, benefit that you'll hear a lot of people who are in the sales role for a lot of these private equity funds say, "Oh, you're way more diversified than you are in publicly traded stocks." Is there, in your opinion, is there anything to that, or is that sort of a contrived sort of concept there?
I mean, I guess the research that I've seen says that there are ways to replicate the exposure to private equity via public equities, be it small cap indices or things of that nature. So, I think arguably if you ran the statistics on it, there's probably some diversification benefit to having private equity exposure. The question is, do you have to get that exposure via private equity, or could you use a highly liquid correlated vehicle to private equity that gives you the same diversification? And I think it would come down to each individual portfolio. But to me personally, I don't see it as a big diversifier because I guess you're still subject to the same risks in the stock market, right? I mean, there are these charts that people typically show, and it's here's the S&P 500 and it goes up. And then they'll show the private equity index and it really tracks it. The only difference is it doesn't get marked up or down as much as the index does. So in theory, it has less volatility. But realistically, I'm not sure that's true. If there's no publicly traded market for it, who's to say what it's worth? It's kind of like your house. What's your house worth? What someone will pay you? I could say it's worth this, but it really comes down to when it trades. So there's certainly, I think things have gotten better in terms of marking to market on private equity deals, or private equity funds. It doesn't have the same liquidity. The correlations are very high between the S&P and private equity funds. So I would say, if the diversification benefits there, it's very minor.
Our perspective on this is, Warren Buffett doesn't have a volatility risk problem because he's just so rich and has cash and everything else. But the people who are our clients and the people who are probably getting pitched a lot of this private stuff now, there's always a risk. It's needing the money when the volatility to the downside is very high. And we say this all the time. And we're recording this today on the 4th of March, where there's been two pretty consecutively large sell-off days in a row. I'm assuming that we're going to stay down as much as we are right now. And if somebody called up today and said, "Hey, I need money," I'd say, like, where were you last week? Or where were you 2 weeks ago when the S&P was essentially at an all-time high? And in the real world, modern portfolio theory, standard deviation, looking at volatility, that's great classroom academic stuff. But in reality, most people's exposure to risk is they need money when the market's down, or in this case with private equity, they need money and they're locked up with it. So, risk is an interesting topic, and I don't mean to get too far off, but the real risk in the real world outside the classroom is you need access to money, and it's either in a contraction like we're in right now, or it's illiquid.
I think that's a good point, right? There's a perception of safety, even though private equity is highly correlated to stocks, but you're really trading liquidity for that perception of safety. And most of what I've heard historically is it's about an 8-year lockup, give or take. So if you invest in it, you better, be okay not seeing your money for about 8 years. I think that's, I mean, you guys tell me what you hear, but that's about the average amount of time that I think money's locked up in private equity.